national dwelling values rose by 0.6 in July, with the rate of growth holding firm relative to prior 2 months. That marks the sixth straight month of gains, with the positive inflection aligning with the first rate cut in February. Every capital city recorded increases, bar none. The positive trend in housing values is supported by low stock levels. I'll explain why. So, with national listings tracking negative 19% below previous 5-year average, that's massive. The combined regional markets, 1.7, are no longer outperforming, with the rolling quarterly gain once again favoring the combined capitals of 1.8. So more relative as opposed to outperforming the regional markets and the combined capitals, which is very rarely being seen. Usually one is outperforming the other, and of course, usually the cities are outperforming the regional markets, but that's not the case. On a seasonal adjusted basis, national rents were up 1.1%. That's great news. Bless you, Anita. The 3 months ending July, up from a recent low of 0.5 through the September quarter last year. What other good news can I share with you? With further rate cuts looking likely, housing values are expected to rise further, but steadily. So the outlook for housing values remains positive. We expect values to continue posting a broad-based but moderate rise through the rest of the year, supported by an outlook for lower interest rates. Given that core inflation is now firmly around the midpoint of the RBA's target range, there is a clear expectation that interest rates will reduce from here on in. Across the capital cities, rents increased across the board over the past 3 months. The annual trend in rents has also seen a positive inflection. Although rental growth has picked up, gross rental yields edged lower in July, so that's a little negative on what's going on, reduced to 3.68 nationally across all dwellings, down from 3.71 in April. The highest capital city gross rental yields by far is Darwin at 6.4, a factor of relatively low purchase prices relative to rental income. So, as you've seen with the Katanning properties, currently sitting at a 6.5 return on investment, gross that is, and potentially up to 8. So that just shows you that there is still value out there, especially in places like, South Australia, Western Australia, Sydney, 0.6 for the month, 1.8 for the quarter, 1.6 growth for the year. Melbourne, 0.4, 1.2, 0.5. Adelaide, 0.7, 1.57. Hobart, 0.1, 0.1, 1.9 for the year. Darwin, 2.2, 5.6, 8.5. There is still value out there, as you can see. Yes, it takes a bit of looking around. You've got to be open and you've got to jump and you've got to pay what you have to, but there is still value around there. So I think it's not all doom and gloom for punters either. And I still think there's lots of value. I mean, I would be considering, once Perth has, I think, reached its affordability, because the headwinds are, of course, affordability. Despite tailwinds of lower interest rates, improving sentiment, and ongoing low supply, the housing market is also facing some headwinds. Housing affordability poses the most significant barrier to material rise in housing prices. Elevated levels of household debt are another factor blocking a more material rise in values. So these are the things that are going to keep it in check, and we want it kept in check. Nobody wants, and I want you guys to write this down. Nobody wants, okay, a downturn market. More stock equals more work. Yes, it'd be nice to get more listings, but go prospecting. They're there. Just take them away from other agents. But if you're waiting things to fall in your lap, when they eventually fall in your lap, like they did in 2014 to 2020, when there was 18,000 properties on the market in Perth, okay, you guys were working 3 times, 4 times as hard as what you were doing now with low and less money. Who wants that? Not me. So it's a pretty damn good market for all concerned, buyers, sellers, agents. Yeah, it's pretty bloody good.